Good morning, good afternoon, good evening, and welcome to our webinar as we discuss the top trends of 2021, 2022 and beyond, what you need to be considering right now and what you need to be looking out for in the future. So joining me tonight, we have a powerhouse panelist. Thank you for joining me, gentlemen. We have got Scott Picken, Willem van der Post, Timothy Willis, and David Orban. Thank you for your time tonight. As always, to our attendees, thank you for joining us. You will see at the bottom of your screen that we have a chat box and a Q&A box. Please post your questions in the Q&A. It just allows our panelists and us to easily find them as they get lost in the conversation that happens at the chat box. But you are welcome to chat to us throughout our presentation and give us your input. We love to hear from you. So without any further delay, I'm going to hand over to Scott and get this evening's webinar started.
Awesome. Thanks very much, Lee. I do think it's pretty awesome that we've got such a diverse coming from Costa Rica, Italy, London, and Johannesburg, as I understand it, which is pretty awesome. It kind of gives everyone a window into the future just to get started. So let me share my screen with you and take you to the PowerPoint. You should all be seeing my PowerPoint. Just want to check everyone's got it. Perfect. So as Lee said, we are going through the top trends for 2021 and 2022 and beyond, and what investors should be focusing on. I think this is probably the most important thing. Lee also, I always like with the community to ask people where they're from. So we've already found out that we've got people on four different countries. I nearly said 4 different continents, but I don't know if England and Brexit determines a different continent. But anyway, we've certainly got people on 3 different continents, 4 different countries. But yeah, let us know where you're from. It will be great to get some feedback from everyone. Okay, let's rock and roll. So I think in terms of introductions, Willem is very well known within our community. He originally is a chartered accountant and was one of the youngest partners at Deloitte. He spent the first stage of his career in financial services. There's a bit of an echo coming. I'm not sure where it's coming from. Yeah. He spent the first stage of his partnership in financial services and thereafter as managing partner for Deloitte with the Center of the Edge, an exponential technology and innovation unit focused on discovering new business models and commercial opportunities. He was involved in early stage thinking of reusing space rockets, orbital flight, brought Singularity University to South Africa, and since leaving Deloitte, founded a technology venture firm that invests in exponential organizations, and that's called Simple Capital, and we're going to talk about that more tonight. Tim Willis is a chartered accountant and started with Deloitte. He then went on to be the head of central operations, sub-Saharan Africa for Uber, then the COO of Air Robotics, which secured a $17 million investment from Naspers in the drone space, as I understand it. And since leaving Deloitte, founded a technology venture firm that invests in exponential organizations called Simple Capital. And lastly, but certainly probably with more age and experience than all of us, an expert, David Orban, in exponential technologies, decentralized networks, and blockchain. David is a faculty member of and advisor to Singularity University. David is an investor, entrepreneur, speaker, author, and thought leader on the global technology landscape. He's a founder and managing partner of Network Society Ventures, a global investment firm focused on innovative ventures at the intersection of exponential technologies and decentralized networks. An early adopter of blockchain technologies and an active Bitcoin investor since 2010, he was the first to own Ether during the Ethereum launch in 2014. He has advised and invested in many companies and funds related to Bitcoin and blockchain. And more recently, chairman of the Supervisory Council for Singularity.net and managing advisor for Beyond Enterprises. And so it's really with a huge amount of gratitude that I welcome all 3 of you here tonight. Certainly all authorities in your space as we debate and discuss the future, not only where we are, but where we're going. So welcome to all 3 of you.
Thank you for having us.
Yeah, thank you very much. We're excited to be here tonight.
Yep, thanks for having us.
So just before we get into the Q&A, I just wanted to mention to people, we did a webinar series last year called Wealth 5.0. There is the link, and Lee, if you wouldn't mind posting the link in the chat box, if you're watching the recording, people can go and watch all the webinars. There were 7 webinars there, some incredible content that took place, and many of the content is actually evergreen. So we decided that people could go back and actually watch it. This year, we're relaunching Wealth 5.0 2021. And equally, we've got a very, very exciting lineup. We're starting tonight with David, Willem, and Tim In 2 weeks' time, we move on to NFTs and what they're all about. Then in early October, the 16 macro trends which are intersecting to create a generational opportunity in this decade. On the 19th of October, we're focusing on EdTech and Fintech and why they're getting so much momentum and why there's so many IPOs and how wealth is being created with new funding models. In the early November, we got Kathy Wood and why she is so successful for investing in high growth technology companies and what we can learn and copy from her. And then finally, in the middle of November, we've got impact investing, how to make a profit while living a life of purpose and leaving a legacy. I do want to say that we started 2 weeks ago with Clem Santa. We had a phenomenal webinar. We had over 2,500 people booked for the webinar. And if you haven't watched the recording, I would highly recommend it. Many, many people commented on how valuable it actually was. But the one takeaway from it, when you look at the global scenarios, both in the economy, politically, and even environmentally, is that people need critical thinking. I would recommend reading this book, Thinking the Future. It's really, really good. But people need critical thinking. And the purpose of tonight and the other 5 webinars is to provide you with the information so that you can go out and have that critical thinking. And so without further ado, I actually wanted to get and kick the evening off and to get into some of the questions that we've got. And I'm not quite sure how we'll do the order. So if you don't mind, I've got David at the top of the screen. I've got Timothy next, and I've got Willem next. So that's my suggestion. But I'd love to know from you guys in terms of what do you see as the top trends of 2021? What is going to define 2021? And it's a scary thought that we're on the last day of August, which means we've got literally a month left in this quarter and then 1 quarter to go. You know, it feels like we've blinked and 2021's disappeared. But is it blockchain, crypto, you know, NFTs? What do you think, David? What is the top trends for this year?
Certainly, and maybe we will go back to this. The important question to start is what is your risk profile? How do you diversify your portfolio while maximizing potential returns and minimizing risks? So yes, definitely crypto as well as NFTs are extremely exciting. And if you look at the survivorship bias of a lot of loud-mouthed proponents of one or the other, you will believe, oh, that's exactly where I need to go. But you have to realize that the volatility of that particular asset class is absolutely huge. So unless you have the stomach to potentially absorb the effects of a 30-40% drawdown on your portfolio as far as that asset class is concerned, or maybe even more, you should be extremely careful. On the other hand, for the past 10 years, Bitcoin, for example, has outperformed practically every other asset class that exists. Now, does that mean it is going to be the same for the next 10 years? No one obviously knows, or they shouldn't pretend they know. As far as I am concerned, I do believe that crypto and blockchain and Bitcoin have barely started. And we are looking at a generational shift of trillions of dollars moving in this asset class and others that may we may also mention. So have fun as far as the rest of the year is concerned, but no, do not move your retirement assets into Bitcoin or NFTs.
David, just before we move to Tim, I just want to point out, and I probably should have said this up front, we're not trying to provide any investment advice tonight, and it's purely from a education and understanding perspective. Every investor makes their own decisions. We have to say that, and for obvious reasons, but it is important just to make sure that I am indemnifying our authorities who are giving the best opinions, but it's still their opinions.
Cool, thanks. I think for me, there have been 3 things to look out for. One is crypto really becoming like a currency rather than an investment. So I think as we see the rise of NFTs and people trading in, buying and selling crypto, using cryptocurrency as a more traditional currency, which I think is super interesting to see for investors. I think the second one is sort of new forms of social media. So if you've seen the rise of Clubhouse this year, which is, for all intents and purposes, like an on-demand radio chat room, going to hundreds of millions of subscribers, in a very few set of months. So yeah, those are two that for me are becoming like really clear players. And then the third thing that I've been watching is the growth in 15-minute deliveries in Europe and North America. Just this explosion of companies like Joker and Gorillas and GoPuff. The amount of capital that believes that 15-minute deliveries of your groceries and pretty much anything is important is astounding. And then maybe, I'm sure we'll get onto this a bit later, but SPACs have been rolling around this year, and it seems to be a really interesting investment vehicle. So those are kind of the four things, if I think back on this year, what I've been looking at.
Just so that I understand, Tim, before we move to Willem, what do you mean by the delivery companies? I'm taking notes here, but I just wanted to understand what you mean in terms of that sector. Do you mean the whole sector's got a whole lot of capital or what do you mean exactly?
Yeah, so you're seeing companies like Joker and GoPuff and Gorillas raising hundreds of millions of dollars on the basis that they are going to deliver groceries at the moment in more first world markets within 15 minutes. So from ordering on the app to getting a knock on your door, it's 15 minutes away. And so, it's something like, even I suppose in South Africa, we know like Checkers 60-60, that's 60 minutes is not good enough anymore. 15 minutes is the gold standard. I think I saw a deck the other day, and they were comparing themselves on how quick within 15 minutes they could deliver goods within certain areas. And some of these companies were averaging 9 minutes from ordering on an app to having a guy knock on your door and give you your groceries, which is pretty crazy.
Yeah, it's phenomenal. I've been sitting in London today. Sorry, Willem, I'm going to you now, but I bought an iPad yesterday, and they didn't have the right one in Tottenham High Court, and I was like, well, can you deliver it to me? And he was like, yeah, it turned up this morning. It's actually so awesome because you can go and see it, touch it, whatever, and then I don't even have to walk home with it. It just turns up on my door. Another thing I found fascinating is I live in a big building here, and they knock on the door, they open it, put it down on the floor, and off they leave. And there's my iPad just sitting in the entrance to the building.
And if I may, maybe it's worth to also highlight the counterpoint to that. I gifted a book to one of our newest team members at Beyond Enterprises. She's in New Delhi, a very, very modern city. The book went through Amazon.com, and they needed two types of identity documents for customs purposes, and the delivery took more than 2 weeks. So it is amazing how certain processes that the regulators probably putting in place because they believe they should be protecting their economy can hinder the discovery of what value creation opportunities lie behind the experiments that we are hearing about. No one knows why one should have their groceries in 15 minutes rather than 30 minutes or a day. And that's not the point. It's not about knowing. It's about having the ability to find out. And if a regulator or a policymaker pretends that they know the answer up front, you should vote them out.
Willem, what's your thoughts on the top trends?
Scott, I think you firstly have to be cognizant of your time frame and horizon runway. If you are in the 40 years game, you've got an entirely different profile around risk, around return. But having said that, I will say that I think timeframes are shifting. We see preventative and proactive healthcare as a major trend in the world, still in its early stage, but insane amounts of capital flowing into digital biology and preventative and hyper-customized medicine. This is where we start to see a lot of convergence in exponential technologies, where originally futurists would make us excited about the novelty of a technology in isolation, where now a lot of those technologies are maturing and starting to converge. So in the digital biology space, big data, AI, machine learning, combined with things like 3D printing, allowing for medicine to be made per person with extremely high efficacy rates. And the advent of that, we believe, will be greater longevity and lifespan and lower mortality rates amongst people. In turn, that will mean that we don't retire at 65 because we simply cannot afford to retire. The old model of growing up and educating for 20 years, working for 40 years, and being retired on the basis of the 40-year-long earnings period, starting to shift as people live longer and cannot afford to retire, or want to sit at home doing nothing for so long. And we're seeing green shoots, it's very early stage, but green shoots of big capital acquisitions plays in the education space, because if people live for, let me exaggerate just to illustrate the point, 60 more years, some social structures start to change. How many performance appraisals can I go through over 100 years doing the same thing? I mean, how good can you get at something, right? So I will not choose to be a lawyer or a CA or a doctor. I will be a lawyer and a CA and a doctor, and I've got to choose what order I want to do them in. And the education angle that we see is by virtue of the retraining of adults, both in the unlearning and relearning space, given that I now have more than one career. And in addition to that, we see democratization of investment. Investment vehicles and asset classes that used to be for a select few, the VCs in Tel Aviv and the VCs in Europe and Silicon Valley, are now being driven through platforms to provide a much greater access to every man in the street. They do have longer payoff times, think 5 to 9 years, but because we're living longer, maybe that's not so significant anymore. And within that space, I'm sure Tim and David will know a lot about the types of asset classes in the venturing space that are becoming available to laymen. Very exciting time to be alive.
Yeah, no, it's interesting. You know, I sometimes you get caught up in your own drama, you know, be it COVID, be it riots, be it whatever, politicians. And then you have these type of sessions, you know, with thought leaders like yourselves, and you realize exactly what you just said about being excited to be alive, because the opportunity is endless, you know, around the world. And it brings me on to my second question, which I acknowledge that we're kind of almost in September already, and to kind of move into 2022 is going to happen with a blink of an eye. But what do you, and just by the way, the next question is the whole decade. So like specifically next year, if you were to kind of take 1, 2, 3 things, I don't know, like what do you see as kind of big things that are going to start to move, you know, and get significant momentum next year?
So we have to consider the reaction times of regulators. I love criticizing them, and if they were to hear me, they would be totally justified asking me, okay, what would you do if you were in our shoes? Because they have a very, very hard job. They are elected or appointed to pretend they know. Now, as we look at how they are trying and failing to look at the rapid pace of evolution of various technologies, it is clear that they are falling farther and farther behind. So there will be a point when they will react almost by necessity in a panicky manner. and anticipating or trying to anticipate how they may react can lead to a lot of opportunities. For example, the set of regulations, absolutely reasonable to start with, around KYC and AML requirements, is now being extended to the point where you may be required to justify having cash. When is that going to be the point potentially? When central bank digital currencies are going to be issued by more and more nation states, because contrary to traditional non-digital cash, the banknotes on paper, the anonymity of digital cash must be designed and implemented. We cannot take it for granted. So my expectation is that a lot of the digital currencies are not going to have the kind of anonymity we would expect, even though we will be told, oh, it is just like cash. And this matters in 1,000 different, absolutely legitimate ways. Now, those countries that go into these experiments of designing and deploying digital cash in a manner that is not sufficiently endorsing the necessary properties of traditional cash in the new form are going to suffer, paradoxically, even though they will believe that they are doing the right thing and they are leading through innovation. So in 2022, I think an important component of analysis is going to be the effect of that, because the announcements are multiplying every day.
Awesome, David. It's interesting you talk about KYC. We had a really interesting thing happen in the last week where we had a person that lives in a village that doesn't live, like they don't have a house, proper house, they don't have a proper street. And they had to go to the chief, and the chief had to like affidavit to say where they lived, and we got them approved for KYC. So they haven't invested yet, but trust me, when they do, we're going to shout that from the top of the mountains about democratization. So anyway, let's move on to you, Tim.
Yeah, so I mean, I agree. I think that regulators are definitely catching a big wake up. I think one interesting thing, which is like a hypothesis I have, is I think that a lot of country regulators will try and launch some form of cryptocurrency of their own to try and compete and control cryptocurrency, which will be interesting to see if that actually happens. But if I think about the space that I operate in more, I think what we'll see is quite a lot of consolidation in the startup world. Like just tons of capital has flowed into a lot of interesting ideas, but for these to kind of come to fruition, I would think that some of these competitive plays will consolidate. And I mean, I think probably the biggest one is if you look at 15-minute grocery delivery space, just how many people have been well funded and how that area will consolidate. So I think that's going to be a big one. And then I think you're starting to see emerging themes like NFTs, which has been spoken a lot about. I mean, that's something that, you know, a year ago was nowhere, and this year is, you know, $1 billion kind of industry, and you know, next year will probably be tens of billions of dollars. But also, you know, usage of blockchain outside of cryptocurrency, so starting to use it in other areas and facets. I think that'll be super interesting to see that sort of technology grow. So yeah, I mean, probably the biggest headline from my side is look out for consolidation in the startup scene. I think that's going to start happening a lot in 2022.
Cool. Willem?
Maybe a bit more of a philosophical answer. We have to always remind ourselves that we are human and as such, we exhibit certain traits and general behaviors. And one of those behaviors over centuries has manifested in what now is described as the Gartner hype cycle. A trigger of something new, typically nowadays a technology, building momentum and ultimately up to a point of inflated expectations. This is 2013 when everyone said, we're going to buy our cars and our houses and earn our salaries in Bitcoin. Didn't happen. And then deflation occurs in the sentiment and we end up in a trough of disillusionment. This is where the antibodies have a field day because they feel justified that the thing failed. And incidentally, if you chart the Gartner hype cycle with this expectation and then the trough of disillusionment and then the subsequent maturation, it almost mirrors the specifically Bitcoin price between 2011 and sort of 2017. So oftentimes technology looks sexy and there are a million use cases that draw the simple way of thinking about it and the not so smart capital. However, you've got to go through these evolutionary curves to end up on a maturation curve to distinguish a use case from a business case. And my sense is that the democratization of alternative asset classes is forcing consumers to do a little bit more digging because it empowers them to make more smart decisions with their capital. The consequence of which is that the skill set to differentiate between use case and business is starting to mature as well. So I think we'll see more circumspect investment and higher quality decisions as users have the opportunity to empower themselves with knowledge and skill sets, which are also being democratized. And then, Scott, just perhaps another broad observation is COVID has been devastating for people's health, and it's done terrible things to families, and a lot of sad things have happened because of it. But it's also caused a lot of change in the world by necessity, and a lot of corporates are shaking the fat, and teams are being reorganized. Infrastructure is becoming lighter. Fat, lazy margins are starting to evaporate. If you look at the consulting houses and what they were charging and what they can charge and make now. The consequence of which is that a lot of talented people are now on the prowl for opportunities worldwide. And I think that's a wonderful thing as a fertilizer for entrepreneurship. We know at Simple Capital, we see it every day, that the amount of capital in the world is abundant. The amount of good ideas in the world is scarce. And the number of people that can execute a good idea that is well-funded is extremely rare. And so venture capital really for us has become about recruitment, really, backing talented teams. And as the corporate fat is shook off and margins become tighter and people look for alternative, more fulfilling, purpose-driven causes in their life, I think we're going to see a swelling of entrepreneurship on the one hand and a network concentration in corporates on the other, with a barren landscape in between. And I think we must play smart about positioning ourselves as individuals and as companies and as value providers from now on. I wouldn't even wait for 2020 to start looking for those green shoots. I look for them now.
No, awesome. And I think that kind of brings me on to the next question. You know, we've looked at this year, we've looked at next year. Let's now kind of move ahead into the decade at large. Now, I'm going to leave this slide up because there's some fascinating stats here around some of the changes that are happening around the world over the next 10 years. Just by the way, I watched a documentary last night called Seaspiracy. And one thing that has really highlighted for me is, you know, with the webinar with Clem Santel 2 weeks ago and then Seaspiracy last night, you know, I've always been one that really wants to focus on solving the wealth gap, but the environmental thing is becoming a real challenge as well, you know, and it's going to have an impact on us economically, whether we like it or not. So, you know, it's just a comment that I wanted to bring up. If you look here, I think some of the things that's really important, 80% of the middle class is in emerging economies, 75% faster growth in emerging economies. Emerging economies equal 50% of the global by 2025. You know, 59% increase in food demand, water crisis, 48% think business should be a force for good, 22 trillion in social responsibility investments today. If you go to this side, 90% of the world data has been accumulated in the last 2 years. 1 trillion objects connected by 2022, 90% of stock trading done by algorithms, 66% of the world is connected at any one time. Global population, 10 billion, 13% of us will be over 65. 90% of the under 25s will live in emerging economies. 1.5 million people will move to cities every week. 66% of people live in cities by 2050, and 61% of the global GDP will be created by 750 cities. Anyway, I'll leave that up. I'm not trying to be the authority or the expert tonight, but I just thought this would be really valuable for people, because the one thing that I've learned, and I've had the privilege of going to Singularity University as well, and one of the things I learned there was that what you do is you look for long-term trends and you look for them intersecting. And if you look on this screen, there's a whole bunch of long-term trends that, quite frankly, you'd have to be I probably shouldn't be allowed to say this, but you'd have to be a bit of an idiot not to look at them, because you've got these like long-term trends of growth in emerging economies. You've got these long-term trends of more and more people joining the middle class. You've got more and more people getting access to the internet, to online education. They're going to want democratization of wealth, et cetera, et cetera. And this is going to have a bigger and bigger impact on the environment, just by the way, because all those people are going to need to eat. David, to you, what are your thoughts on this? And I've stolen a little bit of everyone's thunder here, but I'm quite passionate after what I've seen and read in the last couple of weeks.
Elon Musk says that if we keep the rate of innovation constant, we cannot reach our ambitious, aggressive goals. In his case, to move humanity to renewable energy and to make it a multi-planetary species. And he wants to accomplish both by the end of the decade, or around the end of the decade. The way I formulate the same thought is to say that the rate of acceleration of technological change is increasing. And the term I use is, these are jolting technologies. And I want to highlight just a few, because of course there are many. First, if we recognize that not being able to thoughtlessly destroy anymore, only sustainable initiatives are sustainable, it is easy to recognize how crazy oil companies are, not because they keep pumping oil out of the ground, but because they could reap the biggest benefit of the crisis if they realize that their expertise is in moving carbon. Carbon atoms one way or the other way. Who better should be able to understand what it needs to decarbonize? They are the ones that have the resources, have the expertise, and have every incentive. If they don't, they are not going to survive. So this is already a way to understand where investment should go. It should go out of those companies and into something else that is sustainable. The second trend I want to highlight is the unstoppable power of artificial intelligence. We are used to quote Moore's law that tells us that our computers or phones are going to get twice as powerful every couple of years. Already, 4 years ago, Stanford University published a report that says, no, AI is doubling in power every 4 months. And last year, the CEO of NVIDIA, one of the most important chip companies in the field of AI, underlined data they have where they see the power of AI doubling every 2 months. So from 2 years to 4 months to 2 months, that is the increase in the rate of acceleration that we are seeing. And it is going to be as easy to ask the question, are you sustainable? To ask also the question, what is your AI strategy? The last example that I would like to make, and once again, there could be many others, each of them deserving a webinar on their own, is space. where space is not necessarily this incredible adventure of going potentially to Mars. And we just learned a couple of weeks ago that it will be a much more comfortable voyage than before, because a lot of robots, maybe millions of robots, will make the place welcoming for a larger number of humans that will need to suffer deprivations as a consequence that are going to be more limited than otherwise. But space that we see around us in a daily basis, all of us, whether it is the GPS with our cars, whether it is the amazing decrease in the cost of experimenting and launching and using in your business model and in your investment strategies a space component. 2 weeks ago, I met a team who are planning to launch a rocket into orbit from, of all places, Romania, for as little as $1 million, which is once again a few orders of magnitude less than anyone has ever believed it would be possible. Are they going to succeed? Maybe not. But if they are not, the next 100 startups trying, well, one of them is guaranteed to succeed. And this trend is going to just keep going. Space is going to be in everything from agriculture to manufacturing, to energy, to entertainment, and it is an exciting, wonderful trend.
Awesome. Tim? I mean, talking about transportation, we are talking to someone that helped bring Uber into Southern Africa, as I understand it. So yeah, you probably got your finger on the pulse here a little bit.
Yeah, no, definitely. And I mean, I was actually just thinking about that last comment about space and how at Aerobotics, which was, I mean, traditionally a drone company. And I mean, we were flying 1 or 2 meters above some of these trees and orchards. And we realized that potentially we could get the same level of picture from a satellite. So suddenly, like, the need for actually the drone started to disappear, and that we didn't need this drone 1 or 2 meters above the tree, because we could actually get the same level of picture to do our analysis from space. So I think that's just the advancement even in the last, 3 or 4 years. And I mean, I think from my perspective, like when I was looking at that megatrends slide that you had up, Scott, I was just thinking it must be super scary if you're a corporate with a traditional business model, looking at this slide and thinking about all these different changing factors and how you are going to approach the future. Like, so I think that a theme that we're going to see more and more of is corporates trying to embrace these technologies. Some of them will be successful, and some of them will be, I suppose, less successful, and they'll probably be the ones that we don't hear about much in the future. But yeah, definitely that. And then I think, your comment about more and more people moving to cities, just from my own personal experience, I remember when we were launching Uber in Lagos, in Nigeria, how, just being involved in Lagos and how big that city was, and then how big it was forecast to be within the next 5 to 10 years. I mean, this was a city that was forecast to have somewhere between 20 and 25 million people in one place. That's like 3 times the size of, like, what people, the number of people in like New York, all going to be in one place. And so I think as you see more and more people moving to cities and getting there, I think the way we consume goods and the way things change is going to be, that's going to be a definite trend to watch.
Perfect. Willem?
Scott, I don't like to disagree with you, but if you put that slide back up, there are 2 things that I can't say that I'm wholeheartedly supportive of. So I'll make a couple of comments here. For instance, the world population towards 10 billion, I don't buy it. I think, in fact, we're going to see a little bit of an increase in population, stagnation, and then reversal. it is a known fact that where education levels rise, population increase peters off. And there are cases of first world countries, albeit small, with extreme education regimes that have had to institute government-sponsored programs to get people to date so that ultimately they could procreate to protect the growth of the population size, because there were negative growth trends. And so as more democratization to opportunity, connected internet, Starlink, Blue Origin, whoever covers the globe with satellites and connects the planet first at incremental nominal costs, I think that trend is going to go in the opposite direction. Okay, so that's one. And then moving to cities, I also don't buy it. I think you're going to see de-citying, if I can make up a verb tonight. And I base that line of thinking on convergence. You know, we often talk of the advent of self-driving cars. And there are a couple of obviously problems with introducing it in mass. I'm a big supporter, but you're still sitting with a 2D problem vis-a-vis the road infrastructure that had been created. And we are seeing more and more videos of innovators and hackers and enthusiasts that create passenger drones. And if you combine drone technology with autonomous technology, IoT, satellite connectivity, you're talking about pilotless passenger drones. If you're talking about abundance in energy by virtue of harvesting things like the sun and the wind, then the batteries are also not going to be an issue for long. So you take a 2D problem, congestion, pushing traffic through roads, and you just look at it in a 3D lens, which has got multiple, almost infinite vertical channels, and you combine these passenger drones. Why would I live in a city? I would live where it's safe, where it's healthy, where there's fresh air, perhaps animals. And I know that there are different flavors of taste all over the world, but I see people moving further away. There are further away from cities. There are very well-known German car manufacturers with 3 letters in the name that have published white papers about what's going to happen on the inside of a car when people don't have to focus on steering it anymore. And not to be testing tonight's audience, but some of those white papers talk about where to put the handles in the car, because people are going to be having sex in the cars, given that they've got all this, I suppose, capacity for other activities. So your commute to work, COVID has already proven to us that you can do work from basically anywhere. And so you will live where you find purpose and harmony and peace. Don't see that being cities.
It's quite interesting. I was actually thinking, it's funny enough you challenged that, because I was actually thinking you've got David living in Italy, and as I understand it, and David, I couldn't point exactly to it on the map, but I was apparently 40 minutes from you last week, and it's up in the mountains. It's absolutely spectacular. So I can only imagine you living in some small village somewhere. You got Lee living in Costa Rica. You got Willem, who's moving from Johannesburg to Stellenbosch. You got me living in Knysna, and then we've just got Tim that's left in the city. So
Tim is in the town of Bryanston. Yeah, Scott. And then my last point, maybe just for a bit of a conversation fertilization, if you like, I also see additive manufacturing or advanced manufacturing technologies like 3D printing now becoming a thing. So where a residential home used to take 9 months to build and cost a lot of money, you now find, check out housezero.co.za, who create off-grid pre-manufactured homes as a starting point, which means that when you emigrate, just think of what this is going to do to the mortgage market. You can literally disassemble your house, pack it in a container, and move it to wherever you can find land or rent land. What will that do to rental income plays out of the resi world? And then the disruptor for that disruptor is in the space of 3D printing, where we can now print full homes. I'm talking 200 square meters for $3,000 in 24 hours. And think of what that is going to do to slum cities and tin towns, where people have serious identity impacts by virtue of not having homes that are sustainable. There we go. That's our zero picture. If you just scroll left and right there, Scott, it's a bit futuristic and it's not everyone's taste, but this thing is entirely off-grid. It is its own power plant. You buy a service level contract to keep yourself off grid. It's got plants in the walls that recycle your water. So the sustainability green angle is immense, and it's cheaper than what we've known for 100 years to be how to do construction. So you can get a home, you can move the home, you can make a home in 24 hours, you can afford multiple homes. You've got something that moves you around. I'm sorry, I don't see cities becoming more populated. I see the opposite.
Let's move on to, tonight was about looking at trends, but also to, from an investor perspective. Now, any investor worth their salt knows that when there's a lot of hype, you equally need to be careful. And, this is a very simple slide, but it was just unicorns or private companies. So where they're $1 billion, we all know that in COVID last year, a hell of a lot of money was made in the tech sector, even in the stock market. And there's been a lot of IPOs, which we're going to talk about just now. But are they, what are we as investors, what should we be wary of, well, let me not preface it. David, what from your perspective do you think investors need to be wary of?
It is what I started with, really, and maybe put it in more broad terms of their own attitudes, of their own biases, because we are all human, as Willem properly reminded us, and we are driven to excessive enthusiasm. We are driven to look at certain trends or certain sectors in a manner that does not take into account all the available information, especially considering the potential downside. So the way to invest cautiously is very important. We tend to be over enthusiastic. We have to control against that. Now, the amount of information available today is enormous, and the ability to filter and to correctly assess the information is also crucial. We wish all of us could make the decisions from A to Z and know that we are making the right decisions. It's not that it is impossible in any given example, but overall it is practically impossible. That is why platforms, that is why recommendation engines, that is why even meta recommendation engines are important. How many of us spend time deciding what movie to watch, to the point where we may not even end up watching any movie because they spent half an hour browsing? Or to have a movie in mind and you can watch it, but you subscribe to like 5 different streaming services, and then you need to find out where can you find the movie, because each of them, of course, only recommends the ones that are available within the constraints of that particular service. And it is the same with funds. How do you know that the particular fund is going to be the best performing in the future? You can have no opportunity to know. How do you know that a particular advisor is going to pick the type of fund or the components of a synthetic or an exotic financial instrument that correctly reflects your desires and your profile exactly the same as a movie or music recommendation engine achieves or fails in the same purpose? So being aware, being always on the lookout for biases in our decision making, double checking our own instincts is, in my opinion, an important guideline for avoiding regrets.
Right, thanks. Tim?
Yeah, firstly, I was just pondering while you and Willem were talking about cities, like whether, technology at inception is always expensive. And so is it something that only wealthy individuals are moving out of cities and others are moving in or not? So that was just an interesting point that I didn't get. And maybe it's like the full democratization of technology will sort of unlock, what was your word, Willem? Decidifying or whatever. So yeah, anyway, that's something to consider. But I think from my side, super interesting. I'm heavily weighted in the tech sector, and so just seeing your slide about unicorns and what to invest in and what to be careful of. I think it's often difficult to sort of know, what are going to be great trends and where should you be putting your money. And we obviously, at Simple Capital, we do this all the time, and we have to make these calls. And I mean, there's sort of a few things that we look at when we do this. And the first one is, practically, not only is the company making revenue, but do they have the ability to generate, some form of contribution to their fixed costs. We're not really that worried, at least from profitability perspective, because we know that, at scale they can make that work. And I mean, even if you look at a company like Uber now, they are still probably scaling and still trying to make it work. So even though that unit cost makes sense and they can make the profit, they're still scaling. And you have to ask at what point. I mean, they're valued, I just checked now, at like $80 billion on the stock market. At what point, will the scale hit? But the enough investors who really backing that company. So I think identifying core trends and being able to disrupt yourself is critical, even in tech companies. I mean, I always remember when we were at Uber, we kind of had Uber Black, and then launching Uber X was kind of unthinkable because we knew we'd cannibalize most of our market with Uber Black, which we did do. But the growth was huge. And I mean, now in South Africa, they've just launched another product, Uber Go, and that's completely cannibalized Uber X. But the growth is huge. So every time if you're prepared to kind of disrupt yourself, I think that is a strong sign that a founder is prepared to experiment and prepared to try new things and prepared to do that. And for me, that is that's something I would look to strongly from an investment point of view. Like that ability to almost disrupt your own business model, which is very weird, because traditionally we're looking at will this business model work? But it's almost like, will the founder or will the CEO almost be prepared to take that risk and disrupt their own business with newer technology or different prices or different products? So yeah, something to consider.
Willem?
I'm just taking a second to digest this input. This is it's like a flaxseed pizza base. It's very dense with information. So
I'm taking lots of notes. I've turned on my phone.
Hopefully healthier than whatever kind of pizza you are thinking of.
Oh my word. Scott, in terms of the sort of investment macro trend, in August of 2018, 181 out of the top 220 CEOs in the world signed a document that was essentially a petition or a mandate to federal government to relook the definition of a company, in that they wanted to distinguish between companies that are profit-driven and those that make profit whilst being purpose-driven. And this went way beyond a quick tagline in your financials or your marketing people coming up with a catchy phrase. So this is not your company's slogan. This is your reason for existence. And where that purpose served the greater society, which I can appreciate is still very loosely used terminology and a very ambiguous theme, but it's starting to crystallize, where if the purpose of your company is to profitably serve society, then we are starting to talk about true sustainability. So whether you are a proponent of charity or not, it's not a sustainable model, because someone has got to fund that charitable cause. And so the thinking around sustainable, purpose-driven profitability is catching fire. And those 220 CEOs were the big dogs in the world. They were not the small stock exchange top 500 companies. They were world's biggest. So there's a lot of very serious momentum, thinking, brainpower, and talent behind this trend. And I think energy, space, food, education, wellness, mental wellness, fulfillment in work are trends around which you're going to see a whole lot of public money flow into, which means there will be shysters and there will be use cases that absolutely cannot make it, but with great marketing look attractive. And I think we have to be on our guard as individuals to not fall for the use cases, but to seek out the business cases within those tram lines. That sort of purpose-driven sustainability with profitability behind it is going to be hugely lucrative to capital. And as the world starts to formalize its regulation and its identification of those types of enterprises, I think there will be great opportunity, not only to make money, which is a very important thing, but for fulfillment in serving the greater society. It's not PC and it's not feel-good propaganda. This is a real macro trend. And we see gazillions of dollars starting to flow in that direction. Even some fund managers that have killed off follow-on rights and further investment into non-societal serving type of investments where they are heavily exposed. So it's not only just a new trend that's starting, it's an old trend that's starting to reverse as well at the same time. I would educate myself a little bit around reading materials in this space to start to depict what does the world regulators and the governments of the world look for in what they call purpose. Where are those companies? Who incubates them? Where do they find their seed capital? How can I, in a democratized way, get involved in those? I think it's early days, but I think that is one to watch out for.
Excellent. So I am conscious of time here, and I'm sure most people on this webinar could go all night because this is very interesting, but I am conscious of the time. We've had a very interesting 18 to 24 months with COVID and then the explosion in the tech. But what's also been really interesting is there's been a massive amount of IPOs. Now, I did try and do some research, and the best graph I could find was only to the end of Q1. But the amount of IPOs has just like dramatically increased. In 2020, it dramatically increased, and in 2021, it was nearly halfway of 2020 and after Q1, to put it in perspective. So I can only imagine what it is after Q2 and even now almost Q3. I couldn't find a graph that represented it, but it's definitely happened. What's kind of your take, to all three of you, on why these IPOs have happened and why is it accelerating so quickly? David?
Central bankers don't understand the deflationary power of technology, and they don't realize that there is no way they can get back inflation to the levels they would want, even if they are releasing trillions of dollars into the economy through an unending quantitative easing that represents just the horses being let go and do whatever they want, and they should be in charge and they are not, including negative interest rates, which are an even more desperate measure to push money into the economy. The traditionally safe treasury bonds in the US and other national bonds all over the world have no ability to generate any return anymore. And as a consequence, the money sloshing around has to go somewhere. After the Enron scandal 20 years ago, regulators restricted IPOs excessively. The compliance costs alone in the United States were a couple of $1 million per year to be able to be a public company. The new tool of special purpose vehicles for bringing companies on the stock market are not really a scam, but are certainly a hack to get around and facilitate the desire of this money to move through the public markets. Private investors need to get liquid, and they are able to do so with SPACs. A lot of the SPACs resemble startups, and startups shouldn't be public. The reason for the investment phases from seed to A round to B round to C round to D round and then maybe public are exactly to represent a gauntlet of iron strong maturing, of stealing of the ability of the companies to generate sustainable value. And SPACs, by definition, haven't gone through that gauntlet, and most of them are not going to be able to generate sustainable value. So tens of billions, maybe hundreds of billions, maybe trillions of dollars are being misallocated. Yeah, it's gonna be a disaster.
Well, on that positive note, Tim, what do you think?
I don't have as much of a dire view. I do think, like a lot of what David said, I agree with around, there's a lot of money floating around, even more so after COVID, and it's looking for a home. I think that something that shouldn't be underestimated is that, your big tech companies really got going in the mid 2000s, and they produced, hundreds and thousands of kind of entrepreneurs who grew up in Facebook and Amazon and even Uber, and who went out and had many good ideas and started their own business. And they'd seen success in terms of, hey, we can raise money and we can get this going and we can start something. And I think you just saw this huge boom of companies being founded and started. And I mean, even if you look today, I think there's still more and more of it going on. So I think there are just so many good ideas out there and so many teams of people trying to build the next Uber or Facebook or, whatever it is. These ideas need capital. And I mean, if you're looking at, if I go back to my 15-minute retail or 15-minute grocery delivery companies, I mean, over $1 billion and like probably in the last year has been pumped into this idea. And so these investors they need liquidity, and that liquidity comes through IPOs. So I think that's probably one of the big drivers. Is one, there's a lot of good ideas. Two, there's a lot of capital, and it's kind of like a match made in heaven of capital and good ideas meeting one another, and then needing liquidity to realize those gains. And then, yeah, I think the final point is SPACs. Just around this new technique, or as you called it, David, a hack. To list a company has made it significantly easier. And I mean, you're seeing crazy things like celebrities who start a SPAC. And I mean, at the beginning of a SPAC, you don't even know what company the SPAC's going to actually acquire. You pretty much are backing someone who you just say, hey, they're going to go and buy a great company. I don't even know what company they're going to buy. And you're seeing celebrities raise these things and be able to go and buy, startups that are worth hundreds of millions of dollars, even billions of dollars. And then take 20% share of that company for being able to raise that capital. So yeah, I mean, it's pretty crazy. I'm pretty confident that in 2022 SPACs are going to be severely regulated, and I don't think they'll be around as much as they are in 2021. And on the back of that, you'll probably see a decrease in IPOs just because it'll be more difficult. So yeah, those are kind of my key thoughts around the space.
Philip?
Sure. I think I will take more of a Switzerland stand here between Italy and Bryanston. My sense is that this flush of capital does hold a lot of risk, and clever marketing might easily detract users with allure of the sexiness of the return to forego their discipline. You know, Scott, Lee, we help corporates invest in technologies and in opportunities to help them safeguard against future disruption. So in other words, to be on that train as opposed to be hit by the train. And there are a couple of interesting things, like if you look at some of the coal companies, a lot of them have got the word coal in their name. And so they're actually prisoners of their name. And for 100 years, they've been successful. So they're, in addition to being a prisoner of their name, they're also a prisoner of their past successes. And even when they realize they have to do something different as regards their balance sheet and future-proofing, they don't necessarily have the skills in-house because they became really good at what they do for 100 years. So to now pivot and change course for an established enterprises is extremely hard ask, and that's why they insource people like us to help them with that. And what we see is that initially there's reluctance and fear, much like there is for private investors. And then there's that Gartner hype cycle, inflated expectations. Let's invest in everything. And right there, the corporate faces the same issues that the retail investor faces, which is the allure should not cause you to forego your discipline. We produce 50-page DD reports on these investments that we turn before we pay a single dollar into that underlying enterprise. And I would urge people to get on board with the enthusiasm, but retain your discipline. And for me, that's a little bit of the balance between SPACs can invest in anything, and SPACs are an absolute hack and they must be avoided. Discipline and due diligence is not something that I've found personally a substitution for in this day and age.
Willem, I mean, we've spoken about this many times, is how quickly capital moves in places like Silicon Valley. And, you know, I mean, there you've got people, I mean, I always say founders wake up on a Tuesday morning in Silicon Valley and by Friday night, they've closed millions of dollars of funding and it's wired into their bank accounts. And how do you balance discipline and kind of following that whole process while everyone around you is investing at that pace? I think it's one of the biggest challenges like we have, and I don't have a good answer for it. I just think it's a big challenge that we have with such free-flowing capital markets.
Let's move to this this final question of mine, and this is around, you know, the slide I know says crowdfunding, but you've spoken tonight about venture capital, PE, call it crowdfunding, call it technology, the old traditional way of doing it. David, you spoke about bonds. There's definitely a change in mindset, both from private investors and from corporate companies. You're a venture capitalist, David, with your VC firm out of New York, and equally Willem and Tim, you're also venture capitalists. And I'd love to just kind of get your take. We've spoken a lot about funding tonight. We've spoken a lot about the fact that there's a lot of funding out there, but how do people also participate in it, versus the traditional way, the new ways, and even more importantly, where the future's going?
Absolutely. Venture capital used to be largely defined by exclusive access to the investment opportunities, to the detriment of everyone else, with the VC firms being proud of not anyone but them being allowed at the table and be able to decide who to back, who to not allowed to experiment through their startups. One of the reasons I'm very excited about blockchain is because it increases 1,000-fold the opportunity to experiment novel solutions to challenges we all share. That doesn't mean increasing 1,000-fold the success rate. It does mean, though, that the barriers are radically lower, and the opportunity to participate with awareness, with understanding of the implications by people who were excluded previously is what is bringing so much opportunity and allows so many projects to see if they can make it. So instead of 99 out of 100 failing, it is natural in the blockchain world for 9,999 out of 10,000 to fail. And we should not superficially and hypocritically term those who fail, oh, it was just a scam. Yeah, there are also scammers, plenty, in everywhere, you know, in startups, in the public markets, everywhere. There are scammers too. So VC is being disrupted because both geography is not a defining factor anymore, with companies popping up in London, in Mumbai, anywhere and everywhere, as well as remote teams organizing and not even having a official headquarter anywhere, what we call the decentralized autonomous organizations. And because the cozy white men's clubs that used to be VCs cannot keep the doors shut anymore, and opportunities are popping up. It is really about only the desire to participate and the ability and the willingness to learn. Being a VC is a hard and demanding job, and so no, not everyone should be one. But the opportunity of investing in startups, which is an angel investor job, is wonderful and available to today literally everyone.
I actually had this next slide with angel investors, so I thought I might as well put it up while you talk about them. Tim, I'll leave the slide up while I mean, obviously I'll ask this question here, but I'll leave the slide up while we talk about this change in investment habits. And I mean, I know you've been helping a lot of angel investors to participate as well.
Yeah, so I think one of the biggest challenges with angel investors is, I mean, there are a lot of these points that you've got on the slide. You know, have a clear and documented screening process. Look at lots of deal flow. Like this almost becomes like a full-time job of how do you do all of this to make good investments. And for sure, you'll get lucky and you'll get access to a couple of deals that will be good. But if you're doing this on a sustained basis, finding that will be tough. I mean, it's something we've tried to solve for at Simple Capital in some respects, is that we can be effectively a VC to our investee companies, but give you know, I suppose the benefits of crowdfunding to our investors, so that we kind of take away some of those challenges that you would have in that picture. So I think there's a super interesting space. I mean, if you look, I mean, I always look to the US market, and I mean, you can see what's happening on apps like Robinhood, with every man in his basement kind of investing in everything that they can get their hands on. One thing a specific theme that I've seen in the US has been this growth of the syndicate. I spoke to someone based in New York yesterday who leads a syndicate of 2,500 LPs, and they're just investing in prop tech. And he basically wrote a check of $10,000 on the call, and we'd been just chatting for 17 minutes, to be followed by another check of nearly 50,000. So I think this idea of syndicates and people trying to find someone that they trust and follow is kind of a partial way of people trying to, almost outsource some of these top tips to someone else. But yeah, as an angel investor, it's a really tough world, because whether the person who's investing your money, you've really got to decide, like, does this person have all of these best interests at heart? And that's a really tough decision to make, is how do you decide who's the best person to follow, and which syndicate you should be joining, and which deal you should be investing in. It's challenging.
Willem, we've got some good insight from the two of them. If there's anything you want to add, please do. But I'd also like you to talk to what a lead investor is. And it sort of ties in to some extent with what Tim was just referring to, where, angels often want to follow syndicates or be part of syndicates or follow some sort of trusted source. And that's sort of my understanding of what a lead investor often is. Would you mind kind of, if you've got something to add on the previous question and this one, I'm just conscious of time to evolve it.
And now I'll come to the new topic. I think it is important for investors to know a little bit about the S-curve. So there are 3 sort of stages broadly. You can drill down deeper, but there's the initial stage of a business when it's start up. So it is a very tough-minded entrepreneur that cobbles together a solution, builds an MVP, tries to get recurring revenue going. Then there's the scaling bit where you figured out your unit economics and you now need to jet fuel this thing, and you're not going to bootstrap it out of profit. So you're taking on capital and you're highly accelerating. There we go. Thanks for that. So that red one in the middle is a nice depiction, and the one on the top left also. And then typically there's the more mature phase where you enter into IPO space and you get into the sort of 9 to 15% growth, where institutional money like pension funds and over-the-counter trading of your shares start to ensue. Now, 10 to 15% is not a bad return if you haven't known better before, but going from a valuation of $1 to a valuation of $1 million is obviously a much larger return, with which normally the risk is much higher because the company isn't mature and it hasn't gone through the gauntlet that David has, I think, so well articulated to make it iron tough. Now, in the very beginning, your funding comes from 3 F's: fools, families, and friends. And it's people that give you a couple of bucks to get your system and your product going to sell. As you mature up this curve, before you get to private equity, there are a number of raises that you will undergo, because you're burning more cash than what you're earning for that growth that Tim spoke of earlier. And as you go up this curve, you become more mature, your investors become more sophisticated. And at one point, it's not a couple of people that give you a couple of bucks anymore. It's now a fund. They've got a mandate. They've got an investment committee. They do due diligence. They've got discipline and diligence in their processes. And at some point, you ask for too much money for one entity or one juristic person to give you, which means 3 or 4 investors clubbed together, and one of them has got to take the lead. Because when I took money from Scott and took money from Tim and took money from David, I could give them each a different deal, because they only gave me $10 each, and I could cut a deal that made their wallets work for me. But if there's 4 institutions and they've got lawyers and DD teams, they want to know that they're getting the same deal. I don't want to spend my time as a startup founder or an early stage company stopping the revenue growth of my company to deal with making the deal. And it takes a lot of time. So I'm going to get one investor with one legal team to make one set of terms that everyone in this raise will be a part of. Typically, that lead investor will also give me the most amount or the biggest chunk of money out of the total raise. So if I'm raising $100, the lead investor will give me something between 20 and 75 of that 100. But the terms that that specific funder makes with me is the same set of terms that apply to all the other investors that come onto that particular investment opportunity. So you need to make sure, is this a friendly? Do they know what they're doing? Do they understand scale? Can they give me more than money? Because as I said, money is abundant, good ideas are scarce, good people to run good ideas are rare. So I can take money from anywhere. Do my capital partners bring me a little bit more than just money? And what do they bring? Is it skills? Is it network? Is it access to the market? And so you want to be circumspect about who you make your lead investor. I hope that's like a 1-minute summary or a 2-minute summary of something that normally is taught over 2 years at proper universities.
Awesome. No, thanks very much. Look, what I'd appreciate is that if people want to put any questions up. We've been through a lot of questions, a lot of information tonight. What I want to share with people though is I just want to wrap up some ideas, and then I'm going to come back to the Q&A. If you look at it, and just to remind people, go along and look at these different webinars if you enjoyed this one, and it's not over yet, but we've spoken about a number of these different trends and where people can actually go and get more information. And interesting enough, Willem was talking about the impact of the impact of impact investing and purpose, and it's actually what we're ending off with in November. Because I completely agree with you. I think all of these things become really important, but ultimately purpose is going to determine the outcome long term. What I wanted to share with people is that from our business perspective, it's a fairly simple marketplace model. You get quality supply, it gets listed on the platform, global investors get access to it, and then they can actually invest through the platform. And there's effectively 4 simple steps where you sign up, you complete your profile, you fund your wallet, and you invest. So if you take the platform, you literally can go in, you can log in and set up your profile to start off with. You choose the country you come from, you choose the type of investor you are. It's all called self-certification. So you choose the type of investor you are, which then limits what you can or can't do from a compliance perspective. You then go in and you actually verify your account and complete your profile. It's all online, it's all automated. And like I said to you, if a gentleman in a village with no address can do it, then the rest of us can do it. But it's only once off. Once you've KYC'd once, then that's what it is. It's done, and it takes you through the entire process. The next part is that you upload all your documents and everything else all online, and it's all digitally connected, and ultimately has to be verified by European compliance. Then it starts to get exciting. Now you fund your wallet. So if you've ever bought a property or done anything, that you've got to fly overseas, you've got to set up structures, you've got to open bank accounts. It's an absolute flipping nightmare. Now you can literally go online, you can fund your personal digital wallet. It's a partnership with us at Lemonway. They're the biggest digital wallet provider in Europe. They've got 6 million wallets. It's protected by European law and 5 of the top banks in Europe. And so I couldn't ask for me as an investor for a better way for me to invest, because I can literally put my money there. I can diversify around the world simply and safely, and I can get all my money back in one place. And then basically I come now to the fun part, which is the investing, and whether it's real estate or alternative investments, I can now go in on the platform. I can read all the different information. I can look at all the different returns. I can see the risk categories. I can understand all the different risks. The part I like most is the returns calculator, where I can go and actually see my returns, what I'm going to get per year, what the costs are. There's no costs hidden on page 23 in some addendum that you don't see. And you can also go through and you can see who the partners are, what the due diligence is, etc. And once you actually like a property that you'd like to participate in, this one as an example was a development with John Raby in Portugal, and you want to go and invest, you literally go in, you put in the amount, you digitally sign the documents. Obviously you read them, because all of you read all your documents, and literally there it is. You've bought and invested in Portugal. What you saw there in under a minute was someone being able to invest in Portugal. But whether it was Portugal, America, England, or Australia, you now can invest. And we've actually got members, and this actually needs to be updated. Sorry, this slide is out of date. I thought this was updated. We now got members in 170 countries. We've done over $1 billion worth of deals. We've had over $100 million invested through the platform, over $8 million paid out. And it's really getting quite exciting now in terms of the accessibility. What I wanted to share with you, and we're going to go more into this over the next couple of webinars, but it's the next 5 years, because this asset and wealth management is dramatically changing. And there's a whole report that was done by PwC in terms of where the market's going. And if you look at it, I want to just bring out some highlights. From 2016, it was 85 trillion. It's gone to 111 trillion by 2020, and it's expected to go to 145 trillion by 2025. They expect to see fewer firms managing more assets with significantly lower costs. And sorry, let me just get rid of my camera screen here. It's so interesting when you get so used to working on 2 screens, and now suddenly you got 1 screen. Faster growth in Latin America and Asia Pacific. Alternative asset classes like real estate, private equity, and private debt will more than double, equaling 21.1 trillion by 2025, accounting for 15% of global assets under management. And active investments will continue to lose market share compared to passives and alternatives. And if you take that into account, and you've got all the graphs here, you can go and read all the reports. But if you take that, just 1% of the alternatives is 211 billion business. If you take 10% of that, it's 21 billion. And if you earn just 1% of that in fees, it's $200 million a year in revenue. So it's really quite astounding. Tim, you spoke about Robinhood and what's happening in what we call secondary markets, which is where people have got access over the last 30 or 40 years to be able to invest directly in the stock market. But where there's been this massive boom in these secondary markets, it's now time for the primary markets. And just like Elon Musk said with Tesla, he said, we've got a secret master plan. We're going to build a sports car. We're going to use that money to build an affordable car. We're going to use that money to build an even more affordable car. And ultimately, while we're doing this, we're going to provide zero emissions for electric power generation. And if I go back as far as 2014, this was a slide we created where we said we're going to start off with wealthier investors. Our minimum investment was $100,000. Then we dropped it to $10,000, and we're now at $100. And ultimately, one day, we'll get it down to $1. The thing with digital wallets, though, is it becomes significantly important because the average time that someone stays with a bank is 14 years. And when your money is in an ecosystem and it's easy, it tends to stay in that ecosystem. And there's a tremendous amount of value to your investors being in your ecosystem. And if we just take our own investors, based on Kathy Wood's calculations, it would value the business over $32 million. Then from an investment perspective, there's lots of platforms that are out there. You can invest in America, you can invest in England, you can go through a platform out of the Seychelles if you want to, or Dubai, or Asia, or Australia. But the question I ask, when Tim was setting up Uber, the last thing I wanted was to have a different app in every city or every country. If I come back to my investments, it's the same thing. I want to be able to invest all over the world, simply and safely, and manage it all in one place. And then it ties into purpose, where Willem was talking about purpose. No poverty or the wealth gap is literally the number one challenge on the planet. And, for us, we want to help solve the wealth gap.
You have to do that because...
Now, this is a little video I want to share. It's a very short video from Roger Hamilton and yourself, David, on the future of real estate.
You have to do that because the democratization of real estate is going to be the biggest change that happens in fintech beyond anything else. In terms of it's going to disrupt more than the banking system. It's going to disrupt more than what's happening with stocks and shares. It's going to disrupt because basically property is the one last non-distributed asset. I mean, that's just the basics. It's like the process to buy a property is the most ridiculous thing ever, if you actually think about it. And it could be as easy as basically buying a stock or a share, right? And that's what is going to happen for sure.
In the world, there is a huge geopolitical shift underway today. It is designing the new economy of the 21st century. Technology-driven transformation is disrupting incumbents everywhere. Within this picture, there is a need for clear messages, a solid value offering, a great need for flexible platforms that allow for diversification and a correct, transparent risk management. Each of these components are crucial and are available in the Wealth Migrate platform. The value proposition is huge. And that is why, in my opinion, it is now the right time to invest in promoting it and in accelerating onboarding at both sides of the marketplace.
So for me, when you look at Wealth 5.0 and where the world's going between impact, creativity, high touch, high tech, and digital, what we built is a wealth meta marketplace. We started out with Wealth Migrate. We've got the Wealth Point system sitting at the middle. We've got global marketplaces and local marketplaces. We've got real estate, we've got diversification, we've got genres, and we've got community. We then built the Wealth University and the Wealth Movement. Our first geographic location was Wealth China. We did Genius U, which was Roger, who's currently listing on the New York Stock Exchange. We then did a platform out of England called Zuza and Cashbox. We launched Private Wealth Global this year in February, which is our high-end, call it our private banking, ultra high net worth brand. We're just launching Yachty's Wealth. Now, this is where I think it gets extremely exciting because you can get down to genres, and this is to pretty much anyone that works on the super yachts around the world. We're then going to launch Wealth SA in the next quarter. We are in the negotiations to launch Sharia Wealth at the moment. We're looking for the key partner for women in wealth. We'll launch Wealth India in early next year. And then with time, we'll launch all these other geographic locations, millennials in wealth. And finally, one day, Wealth Create. The idea is in 2023, once the mobile app and everything is in place. If you look at where the business is, the first 5 years was all focusing on the high net worth investors, just like the Tesla model. We're now very much in the venture building space, which is about scalable operating profits. Willem's been helping us with this and the unit economics and balancing the growth of the company between operations and venture building. And this is where Wealth Point, our platform, becomes so important. And then ultimately you got phase 3, which you can see in the Wealth Meta marketplace. The team is pretty diversified across many different players. One that I am very proud of to announce that we announced at our AGM is that Willem has recently become chairman of the group, which is very exciting in terms of that space. And you can see the rest of the team diversified, including some of the advisors in the likes of David. And we are twisting Tim's arm strongly to get his name and face onto this board and onto this page as soon as possible. We're also really excited to have Tim Hilton as our CFO and got a huge amount of experience out of the UK, including Rian van der Pfeiffer on the compliance side. If people want to look at the financial summaries and the models, we've got all of that in place, including the use of funds and the CapEx. And really what we've been talking about tonight is the change. In the old days, you waited for a company to IPO. Many people would have loved to have been in an Uber or an Airbnb, but it's a friends and family type operation. You don't really want to be in companies that are complete rank startups that you've never heard of. You want to be in when Willem spoke about the S-curve, you want to be in companies that are in that growth phase. And then you also want companies that have got exit strategies, and something that we've been looking at is the multiple different exit strategies of how you could actually do it. And so in conclusion, what I wanted to share with people is that we actually did a raise with Cedars, which is the biggest equity crowdfunding platform out of England in 2018. We raised $2.5 million. You can see there was about £2 million from 658 investors. We're actually going back to them for the second round. That's the way it traditionally works. And that'll be towards the end of September, early October. And what we're offering our community is for people to participate prior to that. We're doing an entire valuation, which we're getting done at the moment in terms of it. And if you look here, you can, it'll be a comprehensive report in terms of valuations around the value of the company and comparisons. So it's not just me and the accountant having a good go at it. And then really from an opportunity perspective as to how people can participate, we've got two different ways. We're offering a convertible loan where people can earn an interest for 5 years and then have an automatic transfer into the company. What are we doing with it? Well, we're raising $5 million, $3 million in debt, $2 million in equity for strategic acquisitions and commercial acceleration of the business within an ecosystem model. And we're targeting 10x in terms of our current metrics and ultimately, aiming for a valuation north of 100 million. Our returns are based on the size of the investment. The interest is paid quarterly and it's secured against the group's real estate assets. When you look at COVID-19, the group is perfectly positioned. It's incredible to me how many corporates and businesses are knocking on our door now needing a digital infrastructure. And whether it's global entrepreneurs or institutions, it's coming from both sides of the fence. And this truly allows the exponential growth within the Meta marketplace. When you look at the venture building side, we are onboarding, as I've shown, whether it's in geography or in genre, to really help entrepreneurs grow and accelerate their growth within our ecosystem. And it's effectively an incubation hub for marketplaces. And then in terms of, this is a discussion that the likes of David and Willem and Tim will help us a lot with, but we spoke about liquidity and what does one do in terms of once you've got that growth in terms of the listings, et cetera, between the different stock exchanges. The plan is ultimately to grow the business to 500 million in size over the next 5 years with the intention of being a billion. And we've always set our sights on empowering a billion people. And then finally, what are we doing? Each acquisition or new partner that we bring on board is leveraging the Global Wealth Group's worldwide wealth community and our digital technology, which significantly increases their revenue and their profitability. And so the opportunity, if you want to do the convertible debt, it's literally on the platform. There's 3 different steps. It's up to $3 million. We've already got $2 million in the bank. The silver level is $25,000 per person at a 7% interest, which is a 3% discount off last year's share price. We've got the gold level, which is a $100,000 investment. It's an 8% interest and a 7% discount. And then finally, the platinum level, which is $250,000. It's a 10% interest. It's a Class A share and a 12% discount. It converts within 5 years. The capital is protected against the real estate assets, and we've already got $2 million in the bank from this. And then on the equity side, and just by the way, our investor report we shared with our shareholders last week. If you want a copy of the investor report, you can see the full growth strategy, numbers, financials for last year, etc. But on the equity side, we're raising $2 million. At a silver level, we go down to $10,000, and it's at $2 a share, which is a 10% discount. At 100,000, it's an 18% discount, and at 250,000, it's a Class A share and a 25% discount. And then just on the notes, these numbers are based on the 2020 valuation. As I said to you already, we are looking we're in the process of redoing that valuation completely, and it has to be redone before we do CEDAs. And so the last thing that I just wanted to say was that from a Simple Capital perspective, Willem gave me some insight around some of the work that you've done with other companies, Willem, as well, around what you've said with corporates, etc., and almost stress testing a business so that it has the ability to go to the next level, both at a funding level, an institution level, a partnership level. And I'd love you, Willem, just to finish off a little bit. I know you are chairman of Simple Capital and you are chairman of the Global Wealth Group now, but just talk to me a little bit around what your thinking was in terms of how we take the board from a maturity perspective to the next level so that business can move faster through the S-curve.
Scott, in short, we recognize that the Global Wealth Group is transitioning into a new phase of the business's maturation and the growth. And we would like to populate our board with individuals that are scale capable. And that doesn't mean that our current board isn't, but we do believe that we can bolster our current skill set and thereby also stimulate the appetite of institutional money to flow into the group. You will know that the group is undergoing a reorganization also, where we are becoming very focused on what our purposes are, and a disaggregation into those purposes where each is able to raise its own funding and scale independently whilst staying a part of the group as a whole. And so I saw one of our participants asking whether or not the Global Wealth Group is en route to becoming a unicorn. And I honestly believe, given the purpose, what we've said tonight around purpose, investment, and profitability, the flushness of capital, and this need to serve the greater societal good, my personal answer is yes. If we do it right, then yes. And we're going to do everything in our power to make sure that our board, our structuring, our governance processes, and our transparency enable that.
Excellent. Thanks, Willem. And while you were talking, I'm just conscious of time here. So I just put up a poll that Lee very kindly did for us, where if people do want to reach out and chat to one of the team members, then I'd highly recommend it. You can go and read everything on the platform. If we're going to be a digital platform, it might as well be available on the platform. So just look under alternative investments. Do fill in the poll for us. I believe fundamentally that your time is valuable and so is ours. And the more we understand what it is you're looking for, then please let us know. I'll leave that poll open for a little bit more. I'm just interested, if I share my screen, can you guys see anything, or are you just seeing a poll?
See both.
Can you see both? Okay, great. So while this poll is up, you can see the team there in Fritz and Alex. They are part of our community team, where they basically work with our community members and our partners and reach out to them, chat to them one-to-one, where they can actually assist you. They've been actively involved in the company for over 2 years. They've got a very good understanding of where the company is, where we're going, and equally have been part of the last $2 million raise. And so have a full understanding of how the business works, how people can invest, the type of returns that they can get, what the risks are, and then also what the opportunities are moving forward. So as I said, reach out to them if there's anything that you think would be of value. And then, don't forget about the webinar series. This was one of 5 webinars. We've got another, one of 6 webinars. We've got another 5 webinars to come with some equally interesting topics. If you did enjoy it, make sure that you let people know about it. If you watch the recording, share it with others. I fundamentally believe that people need to get access to this type of information so that they can make the right type of decisions for themselves. I'm going to just see if anyone else wants to. I'll give it another 10 seconds or so in terms of people being able to fill in the survey. I think finally, from my perspective, what we're deeply passionate about is ultimately putting smart investing in every single person's pocket. And when I look at it, you know, to finish off with that story, and I kind of stole my conclusion already tonight, but you know, when you consider where we were when we started with a dream 10 years ago, and it was to empower 1 billion people. And how did we get to 1 billion people? Well, if you look at how many people on this planet have access to real estate, it's currently 12.9% of the population, which is currently about 1 billion people. And we said, well, why don't we double that? And we went out and we built this company, and Migrate being one of the platforms, the holding group being the Global Wealth Group. And I think what is very, very exciting in terms of this process is, as I said, in the last week, Gavin and the team at WealthPoint literally were able to KYC a gentleman that lives in a village with no address, where the chief had to sign off to give confirmation that he lived there. And that, for me, is the true democratization of wealth that we speak of. And, you know, Willem, you talk a lot about that democratization when we talk about putting smart investing in everyone's pocket. I often believe that many, many people that are on this webinar consider themselves as part of the haves. And we kind of all want to go out and help the have-nots. But if I've learned one thing over the last year or so, is that there's a tremendous amount of things that I don't have access to. And I've started to realize that I'm more part of the have-nots than the haves. And that's why we always believe so fundamentally in helping everybody to be able to invest like the top 1%. Whether you're part of them or not, it doesn't matter. Everyone should get the same accessibility. And so that's our vision, our dream, our passion, and our purpose. And, you know, I tend to say to people from an investment perspective, if it resonates with you, there tends to be 3 reasons why people want to participate and join our global community. The first is they want to make a profit. They're looking within a time frame, and you need to be realistic. You have heard Willem, Tim, and David talk about it, but VC can be anywhere from kind of 5 to 10 years, you know, private equity, VC, the space. You know, don't be unrealistic in terms of the timeframes, but we are looking to 5 to 7x people's capital in that time frame. The second is you want to be part of a global community where you're like-minded, you're thinking, and you're growing together. And the third is that you want to have a purposeful impact on the planet. You've literally decided that the planet is your legacy is something that's important, and it's not only about profit, but it's also about purpose. And if those 3 things resonate with you, then I highly recommend you joining our Global Wealth Group and becoming one of our wealth partners. It's not for everybody. There is an invite-only status because, you know, we don't want people joining the community that are not right for the community. But ultimately, Lee heads up that community. You can see her contact details there. You've got all the different contact details. And with that, Lee, I wanted to hand back to you. And if there's any Q&As, it's been a plethora of information tonight. But if there's any, you know, good questions that if the gentlemen don't mind spending 10 minutes or so, and we can wrap up with a Q&A.
Thanks, Scott. I appreciate that. And thank you, Jim, for your insights throughout the webinar. We really do appreciate it. A lot of the questions have been answered on the go as we have been going, either the questions being answered by the panelists in the questions that came up afterwards, or questions being typed and answered by members of the panelists. There is just one, Scott, and I wonder if we can touch on this, because although it is directed at SARS, it does relate to any jurisdiction where you pay tax, and it is, what are the regulations and compliance around SARS for the investments on our platform?
Well, I think yeah, sure. That's a tricky question because there's 2 different questions. SARS is not the regulator. So ultimately, where you invest around the world, there's regulation. So in South Africa, you've got the FSCA. In England, you've got the FCA. In, you know, different countries around the world, they've all got their own regulators. And what you need to do is you need to be able to comply with those local regulators to be able to participate. So in South Africa, because the person's using SARS, we have a license with the FSCA. We have a Cat 1 license for the company. We were the very first company in the country to get an equity crowdfunding license. But we've also got our key individual in Rian van der Pfeiffer, who's our our CIO, Chief Investment Officer, is also a Cat 2 license holder, which allows him to hold discretionary funds. So we've actually got all the different compliance to be able to participate. The second part of that question, if someone's asking about Sars, I presume is then related to tax. And that then determines and is very different based on where you invest, where your income is, where you're domiciled. And, Lee, unless I'm missing the question, I don't like to offer tax advice on webinars because everyone's different. But in South Africa, we've got an incredibly good partner in a group called Tax Consulting, and we can put anyone in contact with them and they can assist. Suffice to say, the one thing I will say, if you invest in the Global Wealth Group, it's an offshore company, it's head officed out of London, and you're investing in US dollars. It's a global asset in a first world country that's ultimately going to pay you first world returns.
And I'd just like to add to that a lot of times when you are investing offshore, you do have to apply for SARS approval for you to move certain amounts of funds when it gets to levels. We do have partners, for instance, currency partners who do assist with that. So you get the regulator or the SARS approval before you actually do your investment, and they help you along with the process. So everything is always above board, and we do suggest that you do contact your tax advisors and your portfolio managers to get a better insight on which is the best route for you to invest in. I'm just going through here, and I don't see that there are any other unanswered questions from our community. So I'd like to just throw it back to our panelists and get closing comments or insights that they would like to share that they think could add value at this point. David, could we start with you?
Investing is, to start, very different from trading, as we know, all of us on this seminar. And the reason I mention that trivial distinction is because the mentality of building wealth is completely different from the mentality of taking advantage of a zero-sum game where day in, day out, or hour by hour, or millisecond by millisecond, if you are an artificial intelligence, you are taking advantage of everyone else who you hope are going to lose in order for you to win. Investing, on the other hand, is value creation for a shared purpose. And as long as there is a strong alignment with that purpose, and that the value creation is sustainable, statistically speaking, we all are going to become wealthy or wealthier. And why statistically speaking? Because, of course, there will be variations. Some investments are not going to pan out. But for the past 1,000 years, the history of civilization has been about developing smarter and smarter ways to understand the world and organize society in order for that to be available to an increasing number of people. And the trajectory has been exponential. That is why for a long time this wasn't apparent to too many people. But over the course of the 20th century, and now increasingly during the 21st century, everyone understands that it is up to them. If they participate, they will be part of this wealth creation and wealth sharing opportunity.
Thank you, David. Tim, closing comments or thoughts?
Yeah, I mean, I think it's been super interesting to hear everyone's thoughts. And I mean, I think that, the greatest thing about technology is that there's always a new surprise around the corner, and you're never quite sure what's going to be taking off or what the next great trend is going to be. So yeah, I mean, I agree with everything David said, and I think maybe one point that I always consider is just around diversification and trying to build a portfolio of different things. So yeah, that's super important to me as I look to each of these kind of opportunities is making sure that you have sufficient diversification. Cool, thanks.
Thank you, Tim. Willem.
No, Lee, nothing more from me. I think we're at the point of having dinner tonight. Really fun to be on this panel tonight. Thank you very much for having me and having us. We always enjoy our interactions with the Global Wealth Group community. It's really a privilege to be a part of this. Thank you.
Thank you, Willem. And Scott, closing thoughts or comments?
Yeah, I just wanted to share this. We shared it at the AGM, so this was mainly for our shareholders. This is a very messy slide, but it's actually an incredibly interesting slide in how companies are changing around the world, where it used to be command and control from the top, then it used to be compete in a matrix. Then we kind of gone to the create space, which is where you kind of got the Teslas and the Netflix and everything. But now we're very much going into the collaborative space, which is all around mission and purpose. And I'm going to go into this in a lot more detail when we do some of the later presentations. But I just wanted to kind of highlight, how important it is, where the evolution of business is actually going. Oops, sorry, I need to get the right slide up. In terms of where the evolution of business is going and how businesses need to evolve towards that. And the one thing that if you look at that collaborate model is it's all about the ecosystem. And back in 2015, we actually created the wealth honeycomb, if people remember, and the honeycomb is the most resilient structure in nature and copying nature's laws. And I think what we've created with the Global Wealth Meta Marketplace is that exact same ecosystem, the wealth honeycomb. And now that the infrastructure is in place, we just allow it to evolve over and over again with people, but in a sustainable win-win way. And I loved what someone said here: sustainable, purpose-driven companies. I think this was you, David. Purpose to profitability to serve society. That's where we're going. And our invitation is for people to participate in that if they would like to. I'm extremely excited to be working with the likes of David, Tim, and Willem, because I think that collaboration is where the world's going. No one can do anything on their own. And it reminds me of a saying that I heard first from Dolph de Roos: if you want to go fast, go alone. If you want to go far, go together. That's all from me tonight. Thank you.
Thank you. And that is the perfect ending to a very informative webinar. To our panelists, thank you very much for making yourself available to our community once again. As always, we gain so much knowledge from each and every one of you. So thank you very much. And to our community, who is our greatest asset, thank you for joining us tonight and making yourself available for the last 2 hours as we learned about the trends that are coming and things that we should look out for going into the future. So thank you, everybody. We look forward to seeing you on our upcoming webinars. Please do reach out to us if we can assist, or if you have any queries or comments that you would like to give us. With that, we'd like to wish you good night, good day, wherever you are in the world. Take care, be safe, and we look forward to seeing you soon. Goodbye, everybody.